Morning all. How are we doing? Morning Forex Fire. 3% up this week so far using market reverse alerts. Yay. Good job. Slowly learning and understanding. Excellent. That's what we do. Always be learning. This is the type of industry, unfortunately, where you never stop learning. I still learn stuff. Just happens that way. The never-ending thing. You can never stop learning because there's just an infinite amount of ways to trade. There is an infinite amount of knowledge you can take on board. It's just about finding what works for you. That's the hard part, and that's why everybody system hops, because you're always trying to find the thing that works for you, aren't you? I've just got out of Aussie New Zealand with a break even. They're basically rebuying this monthly high. So this is a monthly high that this is the reason I took that trade short at the monthly high. We've broken it and they seem to be rebuying that high, which would make sense. So I'm out of that one. Decided to get out. Morning, Danny, FTNet, Bill, Harold, morning. If you're here, say hello, because I don't know how many are here because I can't see how many people are in the stream, unfortunately, when they're member streams. I can in the normal ones, but I can't in these. So I have no idea if I'm talking to one person, no people, or 100. I'm certainly not going to get 100 because we haven't got 100 members. But I've no idea how many are here. So say hi when you're here, so just so I know you're there. Evening, Jules. That's weird. You're in the evening and I'm in the morning. Morning, Craig. So today we are going to be covering hi Linus, we're going to be covering identifying good trading levels and when not to trade, and this is specifically to do with price action trading, which is obviously what we're covering this week. So it's about identifying when not to take price action trades and when to take price action trades, and there's a very fine line with it. So we're going to look at that, and there's also another element to this which I've kind of put in another stream tomorrow, which is the targeting for exits, targeting levels for exiting price action trades and why they work, basically, which is to do with limit orders and things, which is what I keep talking about all the time. So exact example here. On the chart, yeah, price hit a weekly level, it bounced because a monthly level, because there are limit orders at the monthly level. That's why that price action took place, because there is a weight of orders at that price point, which previously was a sell area. We broke through that, which means that the sellers will have turned into buyers, which means that when we come back to that point, it buys, because there are buy orders there now. There were sell orders there. Because we broke it, there are now buy orders there. Yeah, so it's the same sort of, everything sort of is very interlinked with these 2 days worth of subject matter. So I'm just going to cover everything, I think, in one session and maybe do something else tomorrow. But I'll see how I get on, because my cold is getting heavier by the hour at the moment. So identifying good trading levels basically is all about, and also today we're going to cover that strategy that Alexander put in here, which is the buy on Monday strategy for stocks. Identifying good trading levels, and the key out of this is when not to trade. So whenever we look at trading, we look at a signal, and the signal we've been looking at this week is price action, which is very simple. And obviously the market reversal alerts indicator, as an example, is a multi-candle price action indicator. So price action is a signal, but signals on their own don't necessarily mean anything. Yeah. So when you get a shooting star signal, and we've looked at basically taking candlesticks when there are two next to each other. Where's that shooting star gone? Where was he? There. Yeah, so that candlestick is a shooting star. So if you programmed an EA basically to say find shooting stars and short them, it would short that. Yeah, there's absolutely no reason to take that trade, is there? Yeah, you're not going to short the lows, are you? It's silly. So there's price action, and then there's price action at support and resistance, which is categorized as PASR. Yeah. Basically, all support and resistance are a level on a chart that you can identify where there has been a reaction in price. Okay. So it's highs and lows and areas that have been that are of interest, and there's a million ways you can do this, and it's quite discretionary a lot of the time. However, there are set levels which are non-discretionary, and those are the ones I tend to use, and the reason I tend to use them is because everybody can see them. Yeah, so things like weekly and monthly highs, so that is these purple lines for the support and resistance propulsion indicator are monthly highs and lows. This is the high and low from 2 months ago. Yeah, this black line is last week's high. This black line is the high from 2 weeks ago and 3 weeks ago. Yeah, and that's last week's. Yeah, so these levels are non-negotiable. Yeah, last week's high is last week's high. You can't get two people in a room and say, where was last week's high, and they give you a different answer. Maybe if their broker was a few pips out, they will. But that is last month's high in this case. Sorry, 2 months ago's high in this case. This high here is this high here. You can't give this to two people on the chart, two people a chart like this, and then come back and say that is not a high. It is. Yeah. So there's areas which are non-discretionary, and those tend to be the best ones to take trades at. So when you see price action happening, there is a probability that it will play out. So this price action we've got here, we've got wicks to the upside there. Yeah. So we've got a bullish candlestick and then kind of a double top with a bearish move. Then we made a lower high, a lower low and a equal high. So it's kind of starting to roll over a little bit. And then we saw a shooting star go in, but it didn't make a new low, but it is making a new high. Remember we were talking about shooting stars and hammers. Where should they appear? At the very top of a move. That is the very high. Yeah. And there's a shooting star there. So then we got a lower low and a lower high going in. So market structure is bearish. And then we got a break in structure. Yeah. Short. But is there a reason to go short there? Have we got a level that we can identify that is making any sense? And the easiest way to do it is when you see some price action you like the look of, draw a line on the high point like I've just done there with a line, and just either go up a time frame and zoom out and say, right, is there any reason whatsoever price would react here? If the answer is no, up to you. You can still take that, and in this case it worked beautifully, didn't it? But if, for example, that price action that I've just talked about there was happening here, there is a much higher probability of that trade working than not working. The reason being is we know how banks and institutions move the market now. We've covered it, haven't we, this week on Monday. We know that they sold there. We know that the bulls tried to come back at them and they hit that level and they sold it again and again and again, and then the buyers gave up. Yep. So the sellers are in control of this market, right? When we get back to this level, the institutions and the banks, if they want price to be continuing to stay below that level, they will have iceberg orders and limit orders placed at that level to automatically trigger when the price gets there. So they want to sell it. So as soon as a buyer approaches the market, they will take his order. If he approaches it again, they'll take his order. If he approaches it again, they'll take his order. And then they won't get through and they'll give up. So that is one scenario. The second scenario is that the banks and institutions that made that move have taken the profit on that move and they are no longer interested in it because the move that they wanted to make here is over. And when we get back to that level, you will see a bounce because multiple parties will see the same thing. However, the order flow is different and it will just fly through it. So we don't know whether or not levels will ever work. But what you will usually find is that there is some kind of reaction, even if it's not the one that you want. Yeah. So here, prime example, that's the Aussie New Zealand I took short because we had price action at that point that said bears are taking control of the market. So I got in, market was extended, we got in at a level, we were expecting limit orders. This is the first time we've come back to that monthly level. If the guys short here want to hold the market short, they're going to add. So they did. So it pushed back down again. I took a profit. Then we screamed through it on news. So that area now ain't valid anymore because they added to it and they got run over. So now who's in control? The buyers. So this is still a valid area when we come back to it. But now, instead of being sell orders there are buy orders. Yeah. So when you see price action happening at areas of support and resistance, the probabilities of that price action, which we know is strong anyway, are exponentially increased. Yeah. So it's like putting together that case, if you like, in court. I haven't just got the knife. I've got the knife and the video. Probably going to get a conviction. If you walk in with the knife and there's no fingerprints on it, there's a 50-50 shot the judge might put the guy away. Yeah, it's a very open and shut case is what we're looking to try and build. Yeah, so taking trades from levels of horizontal support and resistance, you will find that we know there are going to be potentially bank limit orders sitting at those levels, ready to fire. And they will help our price action play out when we see it. So when we get there, we are looking for everything that we've covered this week, which is indecision to start forming, and then lower highs and lower lows to come in with bearish candlesticks. Yeah, bearish engulfings, 3-bar reversals. Yeah, we're looking for the market to hit that level, exhaust, and not be able to continue. Let's get in and join the limit orders and see if the limit orders are going to keep the market down. If they're not going to keep the market down, at least the chance of our trade going into profit, giving us the opportunity to protect it and taking a no-loss trade are exponentially increased. So it's not necessarily going to be a trade that works and makes profit. But if we're using the exit methods that we discussed last week, like a trailing stop on our order, and say, for example, we took a short here with a stop there, and as soon as it got down to there, we trailed this down, yeah, even if it pops up from that point, we're not going to lose money, or we're going to lose less money than we initially risked, which reduces our losses, which incrementally increases our P&L. But the reason we can do that is because we've got the banks and institutions on our side. So where not to take an order from is very simple as well. Not to take a trade from. If you do not see any support and resistance at the level you see the price action happening, it's a 50-50 shot at the end of the day. We know the sellers on board, but are those sellers pulling back, i.e. sell orders on the buy leg and going to continue, or is it a reversal? We don't know. We've got much more chance of it happening there. So taking trades there is not as good as taking trades there. And that obviously played out absolutely beautifully, that one, didn't it? So another area for not taking trades is in ranges. We've got one here. So we use this one because it's nice and easy and it's on the chart. We got a range for 2 weeks here. Yeah, popped out of it a little bit there. So if we see price action happening there, for example, nice bearish engulfing. We got an indecision candle, push, pause, pull, indecision, and bearish engulfing. If we see it happening bang in the middle of a range of highs and lows, that isn't a great place to take a trade, because we haven't got any banks or institutions sitting there with large volumes of orders ready to help us on our way. Yeah, so the same thing applies for price action when you see it happening within a range. If it's happening in the middle of a range, it's not the best place to take trades from. One of the reasons I use RSI is you will never get an RSI extension in the middle of a range. Yeah, because to get to the middle of a range, it's got to have been extended and coming down again. So you don't get in here. And if it's going to be coming up from the lows, you're not getting in. Yeah, this is one of the reasons I use RSI. It works well in ranges. It works well when the market is trending, and it works well pretty much all the time because it's telling you there's been an extension in price. If that extension in price takes us to, as it did with the Aussie New Zealand on that trade there, an area of resistance, happy days, best trade on the planet. However, a lot of it is very discretionary with support and resistance. So taking trades from the middle of ranges, not the best thing in the world to do, is it? Because you've got nobody to help you. In this case, that 3-bar reversal there, or that 3-bar reversal there, both of them worked to a certain extent. But look at the bounce you got off of that compared to the move that you got out of that. Why did that bounce? Because we had these guys who were short and now are long helping us on our way. So the reason that worked better than that is because the limit orders sitting at this level push the market. Yeah. So we've got a lot more momentum potential to help us along the way. Yeah. So basically, whenever I see, and to be honest, now I'm using the EAs. This is one of the reasons I kind of am very sketchy with set files, because if I see a trade being taken, prime example today, right? The EA took that trade for me. I went, that's a good trade, thank you. The EA took that trade for me. I broke even it. Why did I break even it? Because we've had a bullish breakout and a retest of a propulsion move, and we've got no resistance at the price action area. Yes, it was an indicator, a condition entry. Yes, there was a reversal, but is it at a good level? No. So I'm out. Don't like it. If this thing had got me in, accumulated and gone, I have no choice. However, reading price action is not about always getting in. It's about reading what's going on while you're in a trade and deciding, actually, don't like that. Doesn't look good. Why doesn't it look good? Well, they've just retested the breakpoint twice and bought it twice. Don't like it. Yeah. And the trade entry wasn't great. If the trade entry was great, it would be a different story. But so you've got to look at where you see price action, and where you see price action happening will have an impact. Propulsion gaps are another great one. Yeah. So horizontal support resistance at weekly levels and monthly levels, always going to have a decent amount of orders. Actually, let me just cover daily levels as well. So we're looking at a high time frame here, and hourly, pretty much high time frame as well. If you're dropping down to low time frames, yeah, and taking reversal alerts, for example, and retests, we're going to cover M pattern and W patterns in a minute, and those are happening at daily highs and daily lows, which are these blue dotted lines. Yeah, those are very good intraday support resistance. Yeah, because when price breaks out, that's a daily high. Yeah, when price breaks out of a daily high, the people that were short the day before will tend to have closed their shorts and flipped long. Remember, banks and institutions usually are always in. They're always a directional on an instrument. So the people that were shorting this will go, that short's not worked, so it looks like momentum's long, will go long. And they will become part of the buys on the other side. Yeah. So that high there, this is the daily high. We broke the daily high, we came back, we tested it, we bounced, and off we went. Why did we bounce? Because as soon as it broke through that level, limit orders were placed here to protect those longs, and the banks that were short flipped long. If they miss the initial move, they get in on the retest. Yeah. So lower time frames, daily highs, daily lows are always very, very good support resistance. You're never going to get it exact. It will blow through the levels. Yeah. But this is price discovery. Yeah. We are seeing if there is an interest in buying below yesterday's high, or selling, in this case, below yesterday's low. If there is, we will continue to sell below yesterday's low. If there isn't, we will come back up, retest it, and go. Yeah. So This is a news event as well yesterday, but so basically that intraday levels are really good to use on low time frames. M5, M15. If you're scalping silly, M1. 30-minute time frame, not bad. Yeah. But when you move up to the more smooth time frames, as I call them, hourly and 4-hourly, and that you're looking at daily and weeklies. Yeah. We'll look at discretionary levels in a minute as well, and obviously propulsion gaps. Linus, what is that indicator that marked out the highs and lows called? Support, resistance, propulsion. It's this one here. Sorry, I've got a really snotty nose today. So it's this automatic support, resistance, and targets. Yeah, so this is basically what we're covering today, really. So this draws all that in. Everything you see on my chart here, this text, the timer in the corner, which you can just about see, the propulsion gaps, my previous trade, and all the support resistance levels, that's all done by that one indicator. So basically what I did was, there's loads of indicators you can get for free to do this, but none of them did what I wanted in the way that I wanted it done. So basically that's what I tend to do. I built my own. So what I did is I took a load of indicators that kind of did what I wanted, and I put them together, built my own one, and basically made it do exactly how I want it. But you can have a look. There's freebies out there. Mine's only, I mean, at the moment I've got a sale on, so it's only $39, I think, or something. But yeah, that basically just does it all. It's just a one-stop shop for everything I class as being important. Yeah. So, and that is obviously the key for me, is support resistance, because it works. It's what it always does. Bill, yesterday's low could be a stop hunt, if you believe in that, or inducing retail traders to go short, if you believe in that. Did you watch Monday's session, Bill? Yeah. Banks and institutions do not know you exist. Yeah. This is a $7 trillion a day market. Retail don't even put 10 million in, 100 million in on a busy day. Yeah. The banks and institutions are not interested in retail. The whole stop hunt theory, in my opinion, just my opinion, is created by two people to sell courses. Yeah. The reason price exceeds levels, yeah, is because levels are not exact. Right? Different banks and institutions will have different price points they want to buy at. Market makers will want to make markets at specific levels. If they can't find liquidity at those levels, they will find it at a level slightly further on from that. Right? But these bank and institutional traders and market makers that are moving this market are not going, hey, everybody went long yesterday. We know where their stops are. Let's grab their stops and go. These stops aren't enough to fill one order. The volumes we're talking about are tens and hundreds of millions at a time in individual bank orders on a multi-trillion-dollar a day market. If every trader in retail on the planet trading with the top 5 brokers had a stop loss there, the banks would eat it within seconds, and they would still be wanting more. It's not enough. It's basically, people see something happen over and over again. They make up a theory because no one's seen it before, and they sell you a course on it. Yeah. Just my opinion, having been in this industry for 17 years and seen 100 people sell me the same theory. Yeah. And knowing people in banks and institutions that go, what? They don't even use candlesticks. They don't use stops. They don't use anything. They do use stops and limit orders, but they don't use them in the way that retailers do. So the whole theory makes sense from a visual perspective. But what this is bank and institutional orders being triggered at levels, not being any there to trigger, but being some here to trigger. Yeah, that candlestick went above that high because they ran out of orders at that high, but there were some there. Yeah, everyone else will teach you these are stop runs. They're not stop runs. They're just liquidity zones where banks and institutions have placed orders to create balance in the market to conduct business. They don't know you exist. I've used the analogy before, and it always makes people laugh. As a retail trader sitting at home right now, you are a cell in the poo of a fly on the bottom of a banker's shoe. That is how insignificant you are. There's banks and institutions that drive these things up and down, yeah? So the whole stop hunt theory would need a hell of a lot of flies with a hell of a lot of crap to even get the banker to lift his foot up and go, what's that? You just don't exist. We did a thing in the group that I was in my mentoring group. There was a good number of us in there at the time, sort of, there's over 50 of us, yeah. And at that particular time, some of these guys were trading with six-figure accounts. And we did the experiment, which I think many people have wanted to do, which is go down to a 1 minute chart, right? And countdown, put a countdown timer on the screen, and everybody in the room hit the buy button with a large order at the same time. And we said, in 1 second after we've hit that button, we will close the order. It's going to cost us a commission, and it probably will cost us a small loss in our accounts, but let's do it. Didn't bat an eyelid. Yeah, didn't move. Because to move this thing a tick takes tens of thousands of dollars worth of revenue. A tick. So the whole theory, in my opinion, knowing what I've learned about the market of the stop run strategy is flawed. Yeah. The reason this is going to move down from here is because the sellers are selling. They've added more sell orders and added more sell orders. Now there's a high there, and we've exceeded that high by a couple of pips. There's a stop run. No, it's not. It's them adding more volume. They're not going to get exactly the same price every time because the order flow here is different. The ladder has a different volume of numbers at it than it did at this point. But the fact is they're selling an area. Support and resistance is a zone. That is a stop run. No, it's not. It's an addition. But yes, you can call it a stop run if you want to. And I have fallen into the trap of being also brainwashed into this. I call it stop runs. Every now and again, I've caught myself in streams saying they pushed up and they ran the stops. And I say it and I think, you idiot. Because I've been brainwashed by people in the past, Steve Mauro being the key one. You know, his whole methodology of his strategy in his course was don't trade until they've hit the stops. They haven't hit the stops. They've just added more volume into their orders. Yeah, they didn't know you're there. The bank certainly ain't got a stop loss there. I guarantee that. But it's a theory, you know, and it might be right. I might have been wrong all my life. But, and if you want to call it a stop hunt, that's fine. If that makes sense and it helps you to identify what's happening, that's fine. It doesn't matter. If you've got that theory and you take trades when you see that happening short on price action, good. You've done it because you saw a stop hunt. What you've realistically done is taken a resistance bounce. It's just it didn't bounce at the exact point in price. There's a good video I've got on the website, which probably might be worth watching, which is how to draw support and resistance properly. And the whole purpose of me doing this video was to demonstrate the point that it's an area. Where the hell is it? There, I've gone straight past it. So there you go. So it's this, you know, this is an area the banks and institutions are buying. Yeah. They want to buy from this zone. So they will set themselves a target of X price and Y price, and we will buy this area. Yeah, think about the what I covered on Monday with institutions coming in, and Microsoft will say, "I need to buy a load of X, and I'd like this price." Someone else will come in and say, "I need to buy a load of this, and I need this price." Someone else will come in and say, "I need a load of this, and I need this price." And you'll have three different areas where they've all requested a price, which creates a zone. That zone will be full of buy orders. So when you hit it, you're not going to hit the exact price point. You're going to hit somewhere around here. And this is what people see and they go, hey, look at that stop run long. You can say that, but it's actually just an area that the banks are buying. It's just that this time they got through a little bit further because there weren't limit orders there, but there were here. And the next time it came back there, they didn't get down to here because there were limits triggering a higher point. Yeah, and this time it was a higher point again. Yeah, this time when they sold it a little bit lower because they didn't need to go up there to find the liquidity. The market makers, don't forget, their job is to make a market. If they can make a market here at a lower price with their shorts than here, they will, because it's better for them. But if they can't, what they'll do is they'll make a market here. And everyone will go, stop run. No, just making a market. They're just conducting daily business. It's nothing more conspiratorial than that's what they do. Yeah. So that was supposed to be a question, not a statement. Yeah, that's fine. I understand that. And you know, like I said, I don't have a problem with people using the terminology. If it helps you make a decision on it, on a trade, on a price action, the whole thing we're talking about is price action. If you see price action and you see the wick and it goes above there like that, yeah, and you go stop run, short, price action, tick, get in, brilliant. It doesn't matter why you get in, does it? And it doesn't really matter what your theory is. There's not really anybody on the planet that knows 100% how anything works. And don't forget, you'll have one bank doing one thing and one bank doing the other thing. There's always going to be a push and pull going on, which means even if there's banks with tons of capital there and another bank comes along and just happens to put tons more capital through, it will go through it. But if the order they place here is completed here, these guys will beat them back and it will not be the same price. Balance, imbalance, yeah, price discovery. That's what happens. This is not a stop run. This is an add to this order. Yeah. But Steve Mauro and ICT will tell you that's a stop run because you're buying my course. If I tell you I understand something about the market that you don't know, shh, I got a secret. That's what it is. It's all it is. Random. So yeah, but yeah, but don't. I just know more now than I did then. That's all this is about. And like I was saying earlier, you never stop learning in this industry, you know, and the whole concept of the interbank price delivery algorithm, the IPDA, that ICT came up with and has obviously been disproved over and over again. You go and ask anybody in a bank, have you heard of the IPDA algorithm? There's not one person in the banking sector that this actually thing is meant to control that has ever heard of it. It's lies to sell a course. But it makes sense, doesn't it? It's telling you things that make sense. You see them and you go, that makes sense. If it makes sense, then you can use it. Yeah, which is why I don't really have a problem with courses, because they all teach you something. What I have a problem with is the courses that you do again and again that teach you the same thing. And it's not your problem. It's the fact that they repackage the course and sell it as under a different name. That's the difference, isn't it? So, but anyway, I did see a video from Anton Creel saying they do use retail stop areas to make exits and entries. Can be millions in liquidity sitting there, apparently. Yeah. Yeah. But again, why do you think Anton says that? The guy that sells the £5,000 course. Why do you think he sells it? He says that. Think about it. The guy worked in banking. He now sells courses. What do you want to hear? You know, I love Anton. Brilliant. He's a fundamental trader. Why on earth would a fundamental trader be talking about stop losses? Yeah. These are areas of interest, turning points. There is more liquidity there, and part of it is yours as a retail trader if you use a stop loss. I totally agree. And if it's easier to explain it that way, do it. It's just, I don't think it works. I think this is just moving from area to area. That's just my thoughts on it. But, you know, it's one of those things you can argue till you're blue in the face with people about. But at the end of the day, there isn't anybody on the planet that can prove any of this to you. Is there? I can't prove it. I can't prove there aren't any. I can't prove they don't hunt stops. But I can't prove, but I do know that they use these levels. And this is the thing that's important to understand from this part of the price action that we're covering, is it doesn't matter why this black line is there. If you believe it's a bank order, if you believe it's a stop run, if you believe it is a supply zone, if you believe it is a fundamental turning point, if you believe whatever your belief is irrelevant. We can all look at this high, and everybody in this room can come up with a reason for that being a turning point. And you can come up with as many theories as you like. And I'm sure if there was somebody from China in here right now, they would be telling me it's because we've got a half moon at the moment. Yeah. Or it's the 7th. It's not, it's the 10th. But if it was the 7th hour of the 9th day, it turns because it's number 7. It doesn't matter what your thought process is. It's a fact. It turned. It's a fact. The month ended there. It's a fact. The week ended there. It's a fact. This is 100% of its average daily range. It's a fact. There was a large bank order placed there. Why did they place it? I don't know. Aliens landed. You come up with any theory you like as to why they did what they did. It's a fact. And that's what we deal with. Facts. We know support resistance works, and it works because it's there. Why it's there? Who gives a monkeys? Why does your car go? I've got an electric car. I have no idea how it works. I put my foot on the accelerator and it goes forward. That's what I know. I don't need to know how it works. I need to know that when I put my foot on the accelerator, it goes forward. You know, there's 1,000 theories out there. I have people contact me every now and again, and it's become a lot rarer now, saying your EA is never going to work. Why? Just it's not going to work, is it? Because everybody's got it. So what do you mean everybody's got it? First of all, they haven't. If they were, I'd be a millionaire because I would have sold a lot of them. But no, everybody's got it now. So the banks are going to know about it, which means it won't work anymore, because all they'll do is they know how your algorithm works and they'll just make it not work. I don't know what to say to these people. Your conspiracy theory is so unbelievable. I can't even explain where to start with it. Yeah, but it doesn't matter what they believe, does it? At the end of the day, if that's their belief, then do the opposite. Yeah, we were talking about this the other day, weren't we? Anyway, we're going off tangent. First stream here. Welcome, Rodrigo. Your explanation makes perfect sense. Yeah, good. This is it. This is the point, Bill. If it makes sense, use it. If it doesn't make sense, don't. Come up with your own theory, but do not ignore them. Yeah? That is not coincidental. Why? I don't care. It happens. That's what we're here to discuss, is why is this bouncing here? Because it hit that point and it bounced. Yeah? They sold it. They ran, whatever you want. They went down. They came up to it. They hit it to the pip. It pulled away. I'm saying that's limit orders. You can say that the clock ran out on the banker that had to go and make a cup of coffee. Doesn't matter. Then it broke through that level. I'm saying that everyone that was short there has flipped long, because I know people in banks that have told me that they are always in, which means you do what's called a stop and reverse order. If you don't believe in stop and reverse orders, it doesn't matter. But what happened was it broke through that level. I believe there's limit orders sitting here now to prop price up on the people that have gone long. You can say that they came down to here, ran the stops on everybody that did a breakout and put to break even on, took their stops away and then ran away. They didn't think they got them all, so they came back and hit them again, and now they're going to go. I don't care what you believe. The fact is, support and resistance works. And I don't care what your theory is. And I don't really care what my theory is. It's just something that we see, and that's what we react to. Why are these things made? Billion people come up with a billion different reasons for that order. The fact is they happen and they get retested. That's it. That's all we need to know, isn't it? So, which brings me nicely on to the next one, which is propulsion gaps. What's my opinion about pivot points? Pivot points are mathematical lines in the sand, in my opinion. They work sometimes, they don't. Same way as this works sometimes and it doesn't. If you like pivot points, when price gets to them, look for price action at a pivot point if you believe they have an edge. The reason I use ADR is because I have mathematical calculations that I've done over backtesting over decades that tell me the probabilities of exceeding these levels. I use these because I've done the research. I know the odds. However, if I take a trade because of something happening there, I know that there is a chance it won't work. Same pivot points. When the pivot points are drawn in the morning, it will get there. If you see a reaction at that level, use it. I tried trading pivot points, admittedly a long time ago, and I found some success. I found a lot of failure, but you can flip a coin and find some success and a lot of failure, can't you? So it doesn't matter what you use. Use what you fancy. I prefer this and this because I understand this is made by banks. Yeah, banks drive the market. Pivot points are mathematical calculations. If there's no bank or institution in the world that uses those pivot points, why would the banks react at them? They may coincide with things. So if you had a pivot point here today, for example, and your first pivot point was there, and price hit that pivot point, you would go long because of your pivot point. I would go long because of the propulsion gap, and Bill would go long because it's an ADR hit. Does it matter? Yeah, you're getting into the market. Why you get in doesn't matter. What happens after you get in is important because that's how you make money. This tells you to place risk. What happens afterwards, risk management, is how you profit. Yeah. So you can pick anything you like. If something has a strike rate that is good for you, makes sense to you, and you can use it, use it. The reversal alerts indicator is brilliant. It tells me when there's a structure break. Anybody that's new to trading sees this and they go, this is the best thing since sliced bread. And they continuously tell me this is the best thing since sliced bread because they get into trades and it works. And then they tell me a week later, why is it not working anymore? Then we have to go down the whole, this is a completely random thing. And you're taking trades at the wrong places, which is what this is about. Yeah. So if use them if you like them. They're mathematical. So is Fibonacci. Yeah. Price action at Fibonacci. Again, that was something I was going to cover, but I decided not to because I could literally go on forever talking about support and resistance. The ones I like are the banks. The ones that other people like are the Fibonacci's, and the Fibonacci's are also the banks. Yeah. I'll quickly cover it, but it's very obvious. Yeah. Bank profit, bank move, bank profit take. Percentage of orders removed is speculative. Hedge orders, commercial orders remain in the market. We take off the speculative orders, which made up 50% of the move. We pull back to 50, 38%, and we bounce again. Fibonacci will often coincide with previous highs and price discovery breaks, where price discovery holds. Propulsion gap bounces. Support resistance levels. Yeah, but people will get in and go, it's a 50% bounce. No, it's a resistance bounce. You just didn't know about that. But you did know about that. That's the reason you took the trade. It's never ending, honestly. But we looked at exit strategies that are good and what types of strategies should be used with exit strategies. And it doesn't matter how you get in, does it? What do I think about MACD for mean reversion? I don't use it. It's an oscillator. We're kind of going off tangent a little bit, but this is what these are all about. So MACD is an oscillator. So it's the same as this, RSI. Yeah, it oscillates. So it tells you when the market's been pushing strongly in one direction. It's a moving average convergence divergence indicator, which tells you when price has pushed far away from a moving average, i.e. a moving average is divergent from a previous moving average. So MACD is basically measuring the divergence between and the convergence between two moving averages. What happens when a moving average divergence happens is the market pushes. When the market pushes, oscillators go up. All of them tell you the same thing. Market's moved. When the market's moved, the banks need to take profit. So it doesn't matter which oscillator you use. If you prefer the MACD, use the MACD. I prefer the RSI because the calculation, the measurement, and the RSI, I think, suits forex better than others. But a moving average convergence divergence, you can see on the daily chart, yeah? MACD will be screaming at you up here because the divergence of the moving averages will be screaming at you. The divergence of the moving averages will be screaming at you. The convergence of the moving averages will be telling you to do nothing. It measures range, expansion, and contraction. Yeah. But if you like it, use it. There's nothing wrong with it. There's many systems and strategies out there. But like I keep saying, I can give you a billion systems and strategies. But the entry method isn't important. The exit is important because you cannot control where price goes after you press the button. In a short squeeze powered by stop being popped as the market pushes higher. Is a short squeeze powered by stops being popped as the market pushes higher? In theory, could big player keep pushing long and use the stop popping to drive price higher? No, squeezes happen because the supply and demand differential changes within the banks and institutions. Go back to Monday. At this point, for 1, 2, 3, 4, 5, 6, 7, 8, 9 days, yeah, there was roughly, I'm making figures up out of the blue, 5 trillion short orders entered today and 5 trillion long orders entered today. So what we did was we continuously executed 5 trillion orders a day in all banks and institutions. Then something happened and the weight of orders changed to 2 trillion short orders and 7 trillion long orders. So every day, 7 trillion of those were entered, 2 trillion of those were entered, which means that when we ran out of these 2 trillion, we couldn't execute the rest of our longs. So we had to go and find people that had orders at higher levels, selling and selling and selling and selling and selling. When the equilibrium returned, which it didn't in this case, we would have gone back into balance. Balance, imbalance. Yeah? That's what causes that. If people have placed stop orders in the market to short the market, they will get triggered by the overwhelming pressure of buyers. But these guys are not going after stops. They need to get $7 trillion worth of orders executed today because the banks and institutions have been told to do that by their customers. Yeah? There's no conspiracy theories here, guys. This is random price action created by institutional traders because they've got a job to do. They're not conspiratorially standing there going, let's squeeze the crap out of them. The reason this popped is because there was a change in the New Zealand dollar interest rate. It became now less favorable to have New Zealand dollar held in your account than it did Australian dollar. So they sold their New Zealand dollar holdings and bought Australian dollar holdings. The price went up. The demand dropped for holding New Zealand dollar. Nothing more complex. Yeah. But what they had to do was find people to buy the New Zealand dollar. Yeah. So they had to keep getting lower and lower and lower prices for their Australian dollar, or higher prices for the Australian and lower prices for their New Zealand dollar to get the orders executed. Yeah. So a lot of people made a lot of money. And then they went, we've made a lot of money. Demand has changed. Let's take the profit on this leg. And then we'll wait and see what the next news event brings. And we'll either then buy more of it or we won't. Yeah. They're not going, hey, everybody's got stops up here. Let's go and trap their money. That's not happening. I can assure you that is not what the banks and institutions are looking at. But they do need to execute orders. And to do that, you need liquidity. Every bank and institution has a market, well, not so much the institutional traders, but the banks have market maker desks. And the market maker desk's job is to evaluate where the liquidity is available to execute orders. If they cannot find it, they will create it, because other banks want prices traded at, and they will go, okay, we'll give you that one, but you give us that one. You scratch my back, I'll scratch yours. We'll move up and down on the ladder and we'll exchange contracts until we're happy with them. When you've finished exchanging contracts, I need to find someone else. Oh, it's up there. Price moves. It's nothing more complex. They're not looking at anybody and going, you know, it's the whole like sniper entry. There's a guy in here, yeah, who's about to get shot because they got the exact entry because of there's a stop run. Bollocks. Selling a course. Right, it must be the Lemsip. It's basically when the cloud is big, MA ribbon is far from price. And there is a MACD cross. You enter basically, it says that the market is exhausted and it's going to reverse. Yeah. Visual MACD, not the MACD. Yeah. Use what you want, Yusuf. Doesn't matter, does it? Yeah. Your indicator is as good as mine. It's got a 50-50 chance of working. Isn't it? Yeah. If your MACD says getting short and it goes long, you're wrong. If my RSI says getting short and it goes long, I'm wrong. Sometimes mine's right. Sometimes yours is right. Sometimes we're both right at the same time. Sometimes we're both wrong at the same time. But the way I make money is by going, I'm wrong. I'll tell you what, I'll wait till next time. That's the way I make money. Using price action to tell me what's going on in the market. In a short, the stop is a sell order. So a buyer can go for that order, moving the price higher. Yeah. Yeah. Yeah, exactly. It doesn't matter what the orders are, does it? It's irrelevant. This is kind of what I'm saying. It doesn't matter. Whether you believe me or don't believe me, or you believe him or don't believe him, it doesn't matter. What matters is the market moves up and down, and your theory behind why something happens has got nothing to do with anything. Because you may know exactly why a squeeze happens. Unless you can tell me when a squeeze is ending, that information is utterly useless. Yeah? You say to me, we've got a squeeze on because of X, Y, and Z. I'm not having a go at you here, by the way. I'm just saying, if you tell me something is happening because of a reason, yeah, I'll go, that's great. When's it going to stop? If you can't give me the answer to that, which means I know when to short it, the information as to why it's done that is irrelevant. I can see it's done that. It's on the chart. When's it going to stop? And if you can help me out with that, I'm not interested, because that's the only thing I need. And unless you've got a time machine, I don't think there's anything that you can use indicator-wise that's going to help you determine that, is it? Because we don't know. But what we do know is that when price reaches a level that it's been at before, there is a reaction. Believe what I say or don't believe what I say. It doesn't matter, does it? But you cannot deny, no one can deny, that the price reacted there twice after it hit it. Yeah. So the key to exit, as you say, is DCA. Yeah. I am dying laughing, Harold. Please take a clip of what you just said. Bollocks, selling a course. You take a clip and put it as a new subscriber audio every time someone joins. I can't get that working properly. But anyway, on Futures Bookmap can show you where the bids and offers are. Thought Feeder, you didn't do yesterday. We covered this all in yesterday's stream. So apparently gives you an indication of the short stops driving the rally up. Yeah. Go and watch yesterday's stream. It just doesn't. All right. I'm going to say this once, and I've said it a million times in the stream. You're in here because it's not working, right? Bookmap doesn't work. If it did, you wouldn't be here. You'd be trading Bookmap right now, right? Bookmap doesn't work because 99% of the orders you see in the order flow and those heat maps are spoofed. Yeah, they're bank and institutional orders to entice price to a level, and they pull them and it pops. Yeah, you know that, I know that. They teach you that in the bloody course. They sell you software and tell you why it doesn't work. I've done it. I've got the course. I've got the software. But it doesn't matter, does it? Sometimes it does work. And all it is that. It's this. It's these grey lines and these blue lines. That's what you see. You're seeing the future versions of the grey lines and the blue lines. But they don't work because they pull them. Anyway, what happened to today's lesson? Were you talking about propulsion gaps? Yes. Good one, Linus. Bring me back on track. But it's good to get sidetracked like this. You know, it's, we need to know about these things. This is the sort of stuff I'm not planning to do sessions on, so we'll go off on tangents every now and again. So we've done support resistance, horizontal lines in the sand. You can't deny that was the high of the week. There is no discussion. That is it. It's in stone. Every platform on the planet tells you that's the thing, right? Propulsion gaps. So price action. We know it's not good to take price action in the middle of ranges because at the end of the day, the order volume, for whatever reason, which is why we started off on a tangent, whatever reason, it will go from there and there more likely than it will from just anywhere randomly. We also know that taking trades in places like this, which is basically in the middle of nowhere, there is no resistance or support or anything around here, is also not going to be as reliable. So finding reliable places is monthly, weekly highs, intraday, daily highs, previous day's highs, and support propulsion. So support propulsion, obviously we know are large orders. I'm not going to say bank orders, because if you don't believe they're bank orders, that's fine. They're just large orders from retail traders that made the price go up. We know that when we come back to them, one of two things happens. It either blows through them because there is no further reason to add volume, or there is volume sitting here in the form of orders, which either is sitting there already or gets placed by people when they get there. Don't care what your theory is, but it then bounces out of it. Yeah. So when we are trading and we're seeing price action unfold, giving us indecision in areas that are nondescript, then we can just sit on our hands and do nothing. However, when we enter a zone of importance, a previous high area, a propulsion area, we're going to look for reasons to get into the market. Reversal alerts on 5-minute time frames, moving average crossovers showing us bulls or bears have entered the market, or price action. Yeah. And we're going to buy that because we know we have potential participants helping our trade unfold, and more than likely they caused that pause push. Yeah, that's the key. The price action can happen anywhere on your chart. Yeah, 3 long wicks, 1, 2, 3, can happen anywhere on your chart. But is there absolutely any reason why it should go down from there just because you've got 3 long wicks? There is no resistance level. You could say that is, but there's no strong resistance level. We are in a propulsion gap where they added, so that could be, and I'll cover this in a bit, that could be second leg M, which is the next bit we're going to cover at that point. But we're looking for price action to unfold in this area. Same with ADR. When we hit ADR, don't just trade because it hit ADR. I've got someone at the moment that sent me in Telegram, they sent me a message and they showed me their P&L with the market reverse alerts here, and I nearly fell off my chair. I know they're not in here, so I don't mind sharing it. I presume they're not in here. But this is their P&L. 19 trades short on the Euro New Zealand. 21 trades short Aussie CAD. I nearly fell off my chair. And they said, yeah, but I've made 28%. Don't care. That's going pop very quick, very soon. Yeah. Um, but the point I'm kind of getting to is you don't get in just because something happens and hope it's going to continue to happen. You get in when you see price action at that level. Yeah. So that was just an example of basically what they're doing. I don't know what they're doing, to be honest, but what they're doing is using the market reversal alert CA to get in at ADR and then getting in, just getting in. Yeah. You don't just get in, because if it blows through to 225 ADR today, you're dead. Yeah. You get in here when you see some kind of price action. We've covered the price action candlestick patterns. We've looked at candles and why candles happen, why tails are there, what's going on inside the candlestick. Yeah. So you get in at ADR, but if it pushes beyond ADR, don't just get in at 125 ADR. Get in if you see price action telling you to get in. If you get down to here and you see indecision candle followed by indecision candle followed by a bullish candle, you may go, right, okay. But if you see a 3-bar reversal or 2 long wicks back to back, get in. But if you don't see any price action there, don't enter the market. It's all indecision. Wait for it to go to wherever it's going to go to. And if it gets down to 150 ADR, between 150 and 175, and you suddenly see that and that makes sense. Yeah, it's the previous day's low. There's limit orders there. We know that because they tried to get through it before and they couldn't. So everyone that went long there has now got limit orders at the low there and at the low there. And we've got price action. Get in. Yeah. So if this moved down to ADR and you saw indecision and it moved down to 125 and sat there and you saw indecision and it sat down, got down to there and you saw a 3-bar reversal, that's your trade. The skill in reading price action at support and resistance is sitting on your hands when you get there and waiting for the price action to confirm the order that you're expecting or the reaction that you're expecting to trigger is triggering. Yeah. So propulsion, monthly, weekly, intraday levels, and ADRs. Yeah. So those, I'm not going to cover oscillators because oscillators are a condition indicator. So in effect, support and resistance is also a condition indicator. The condition is price action and the condition is a previous bounce. In effect, they are the same thing. But we've also got other areas of support and resistance. So looking intraday, I'm just going to pick something at random, CAD yen. Intraday support and resistance. So if you are scalping low time frame, you may have days, and you will have days, where there isn't much around. Yeah. So your high of the day is all the way up there. Your low, which is a double weekly low, but your low of yesterday is all the way down there. Yeah. So that's what we're dealing with at the moment. So decent level today. You got ADR. This dotted line down the bottom here is yesterday's low. Yesterday's high is all the way up there, and we're sitting around in price action here. If we get to the high of the Asian session and you see price action happening just above it, just below it, or around it, that's still a fairly decent, but it's a previous level of resistance. In Asia, we weren't able to break that level. We know that they were selling that level. If we come back and test it again, they're probably going to resell it. Yeah. So if there is no other levels which are really good coming up, you have got other intraday levels, but this is only relevant for low time frame. M pattern, W pattern reversal. So market structure, as we know, is how the market moves. The market moves in waves and cycles because of how the banks and institutions move the market. So they have a $100 million order to go long. They get 10 million of it executed. They run out of people willing to sell to them, so they cannot execute the rest of their order. They wait for price to push back down to an area where they've got enough volume of sellers to absorb their orders, and they enter the next 10 million and then find more as they push up. They then exhaust that. There are no one left up here with enough volume to execute. So they'll wait for it to come back down, get some momentum. Sellers enter the market and they will buy all of their orders and move up, which is what creates market structure. So when you get a reversal in market structure, price action at this area, yeah, is potentially going to be the next leg. And this is where you can use things like Fibonacci. Yeah. So if you see price action happening after a reversal alert has happened, that is also another good area to start looking for entries. It's not an area that you're going to have help at. Yeah. There's not likely to be orders sitting at the levels ready to fire, icebergs in the market, just sitting there with tons of cash. You ain't getting through. That's what we use at the support resistance levels and at propulsion gaps. However, when you get a reversal, it's the if market structure is going to continue scenario. Price action in this sort of area is also good to look at. This is a little bit more advanced and a lot more sketchy, right? But what you're identifying is the second leg in a W pattern or the second leg in an M pattern. And the problem with this type of entry with price action is, as we know, M patterns can be that, or that. And there's your stop run. Yeah. So that it can be a lower high, equal-ish high, could also be made up of tweezer tops on a higher time frame, which we covered yesterday. An M pattern reversal, as you'd call a stop run M pattern. That's a terminology I use a lot, unfortunately, a stop run M. And I think in the market reversal alerts indicator, I also call it stop. I use the terminology a lot because I was brainwashed a lot into that terminology as well. But all it is can't get enough orders in. A lot more orders come through than we anticipated and take more. That's it. It's just more volume coming in, but at different prices. Market was made there. This is why they call them the market makers, basically, because their job is to basically dump loads of liquidity. Banks and institutions have got not unlimited funds, but they've got almost unlimited funds to be able to do what they want. So on any individual day of the week, there is enough liquidity sitting in any institution to say, if I want to today, I will take price here. It's not in their interest to do that because it creates a lot of risk on their books. And if there's not enough volume of orders, they may not be able to achieve it. But there's enough money for anybody to do that in an institution. However, there's not really a financial advantage because they have playbooks, obviously, they use. So, but yeah, so that's your intraday MW type stuff. So I know a lot of people like scalping, and especially if you're trading prop, it's the whole sitting around on your hands waiting all day scenario. You got a double daily high there. You got yesterday's high and the previous day's high. If the pound odd gets up to there and you see an exhaustion pattern form and price action reversal happening, that is a really good trade. It may just be a pullback and a rally through, but if you can get the action happening, it gives you an opportunity to reduce risk or eliminate risk on the trade before you take it. Yeah, this is the sort of stuff that I was doing in the exercises. Yeah, sitting on your hands, taking 5 trades a day. So if you're sitting on the pound odd now, and I say to you, you can only take 3 trades, for example, today, you're going to wait until you get the ones that are going to work. Because if I say to you, you're risking $1,000 a trade, right? Any money you make today, you can keep. Right? Would you go, oh, screw it, I'm just going to go long or short here and hope? Or would you wait for a high probability setup at an area they've bought 4 times? Would you rather do that or just flip a coin? Yeah, this is what it's all about, putting the odds in your favor. So every trade has a 50% chance of working, because every trade will either, after you press the button, go long or short. However, you can increase the 50% probability by taking a trade at a level that has historical interest and we know has gone in the direction that we're trading in. So that 50% suddenly becomes helped potentially by institutional volume. Therefore, the probability jumps up maybe to 65%. Because if you only take price action trades at support resistance, whichever you want to use, we've covered loads of different versions of it today, that increases that. If you use a 1-to-1 risk reward ratio here, you don't make money. If you use a 1-to-1 risk reward ratio here, you can pay your mortgage. Yeah, and that's how it works. So that exercise that I gave you on Wednesday, yesterday was it, or the day before? The reason that is a 1-to-1, and the reason the banks and institutions, it's actually banks, give you the exercise of the 1-to-1 and say come back with profitable days in a row, is to encourage you to find repeated patterns and entries that work more often than not, i.e. increase your strike rate. Your job isn't to get a whacking great 5-to-1 and go, woohoo, ring the bell, guys. Have you seen the trader just done? Your job is to make money, return alpha into the capital of the bank. Yeah. When price gets here and you see price action happen, if it does that and you're wrong, you can still get a 1-to-1 out of that. No problem. If you're right, you could have got a 5R out of it. But if you only take 3 trades a day and get the strike rate up to 80%, you don't need 5R because you're making money. You're making alpha. You're generating revenue. Yeah, that's the whole purpose behind using levels to trade at. So right now, this is a great example, isn't it, of what I just talked about. Where not to take a trade, right? Where do we not take trades from? Resistance turns support. Yeah? Resistance. Somewhere in the middle of the desert. Water. Where would you rather go? Yeah? No point in trading this. You look at this chart as a scalper and you go, nothing there. You look at the next chart and you keep scanning for support resistance levels and find them. Take your trades there. Yeah? Or you look for exhaustion and you take your trades on exhaustion, which is what I do mean reversion wise. Yeah. If I see exhaustion, this is actually hourly and 4-hourly exhaustion, but if I see exhaustion at resistance, it's 4-hour, I took it on. There we go. If I see exhaustion at resistance, that's an A++ trade. Yeah. Does that make sense? Yeah. So we're talking about price action here, not talking about position trading. We're not talking about stop loss trading. We're not talking about anything. We're just talking purely about price action, which we've been talking about all week. Candlestick patterns, what they tell you, what's inside them, but where they happen. Yeah. So when you put that all together, it gives you a methodology, a system, a strategy on how to trade the market. Yeah. So you sit here and you do absolutely nothing in the morning and you go, is anything getting near a level of support resistance? Nope. Is anything getting level? This is when you look on a lower time frame, obviously, not on a 4-hour chart. But is it getting anywhere near a level of support resistance? Yes. Unfortunately, I've missed it. But that high is that low, and these 2 black lines are previous weekly levels, and price came up into those weekly levels today and rejected them. So where's the price action today? This is a good lesson. Who knows? Well, it's not a 3-bar reversal, right? There's 3 things happening on these 3 candlesticks, which we've covered basically. Yeah. Price has pushed up, made a new high. I'm going to show you on a 15-minute time frame in a minute what this is, and it'll become so much more clearer. But we're looking intra-candle here. Yeah. So price has pushed up. Indecision. Yeah. The bulls have been rallying. Push, pause, pull. Yeah, it is in a way. It's not a 3-bar reversal because this, and this is again what we were talking about yesterday with price action candlestick patterns for reversals. Howard says this is push, pause, pull. It is. What I like to see is more indecision in the form of that or a push, a pull, and a can't get anywhere. Oh, you guys won. In, fight, out. That's what I like to see. This is in, I won. But it is a push, a pause, and a pull. Yeah. So we've got a push into indecision and a reversal where bears took control of the market. And not only did they break the open where the exhaustion occurred, but they break the low of where the bears tried to take them before they lost the battle. Bang. Reversal alert. Structure break. Last bear order got completed. And now the bears are fully in control. Bears fighting to take control. Bears retaining control. 15-minute time frame. Now, it depends on whether these three make a 15-minute candle. But if they do, and I don't know, but if they do, what we're looking at here is a push up. Yeah. An indecision and a pull down. We opened there. We pushed up. And we closed there. What's that make? Yeah. So on a higher time frame, moving up to the 15-minute, and it depends if these three make the one 15-minute candle, obviously, that would be a shooting star. And unfortunately, in this case, that doesn't seem to be the case. God, where's that gone? Which one was I looking at? Oh, I don't know which one it was now. My brain has gone. Yeah, it was the last one, wasn't it? So unfortunately on a 15... Oh, no, it did. Yeah, there you go. So inside your 15-minute candle there is the push, the pause, and the pull. Higher time frame, shooting star. And what is the shooting star on the higher time frame? Push, pause, pull. Same thing. Yeah. This is price action is purely price action. It's exhaustion, reversal, continuation. Candlesticks are how we see price action. And the same thing plays out on all time frames. The lower time frame you go, the faster you'll see the thing happen. The higher the time frame you go, the slower everything becomes. However, the more confirmed everything becomes, the less signals you get, the stronger they are. Yeah, this is what I was trying to explain to someone in the Discord group about time frame being purely a window that you see price points, our orders in a ladder on. Yeah, you go onto an hourly time frame, you've got a bearish engulfing. Yeah, when you go into a 15-minute time frame, we've got that sort of thing. On the 5-minute time frame, we've got an indecision bearish engulfing. Yeah. You can see the same thing. We've got a 2-bar reversal, a 1-bar reversal, and a 3-bar reversal, all happening on 3 different time frames. But that's your entry there. Let's put the entry points in just to show you how time frame affects price entry. Yeah, so there's your entry on the hourly. On the 15-minute, your entry is there, possibly there, depending on whether you used the confirmation there. On the 5-minute time frame, same candle as the 15. Yeah, intraday time frames tend to be M1, M5, M15. Higher than that, you're going up into more what I would call smoothed time frames, which is hourly and above. But you're never going to get the same entry. The hourly entry is the reversal alert. Confirmation. Stronger. Yeah, the price action entry is faster, but not necessarily as reliable, is it? Yeah, but it doesn't matter if there's no resistance at that level, but there is. It's an intraday bounce, and it's also a propulsion move down, which is a break of that level there. Yeah, so this whole area is one big propulsion gap, because that candle and that candle with both propulsion gaps in makes one massive propulsion gap, which we came back and added volume to. We've just added more, if you believe that's what happens. That's entirely up to you. Some people believe in God, some people don't. Some people believe in moon phases, some people don't. Some people believe in Donald Trump, some people don't. Some people believe banks move the market, some people don't. I don't care. It works, price action, and it works support and resistance. That's what I do know, and everybody else knows that because they can see it on their charts. Maybe like GC pushed, now pausing on H4. Yeah, so the price action here is a push and a pause at the moment. We've got 3 hours 35 minutes left on this candle, so you can't make any decision yet because that candle could be there in the next 3.5 hours. Yeah, but you know, whenever you see a potential price setup, and this is a trick that was taught to me by my mentor when I was doing price action trading using moving averages. He said basically whenever you see a trade setting up, yeah, draw the line on the chart and look left. And that's something I cover in the Bootcamp. There's a slide in Bootcamp which has got a load of eyeballs on it and a load of arrows pointing left. Yeah, and it's just me visually saying the only thing you have as a trader is history, because you can't see the future. So whenever you're looking to take a trade, look left and see if there's a reason why that trade should work based on movement of previous price. And I learned all of this before I learned how banks work, how markets move. Yeah, I learned all of this based on purely the guy telling me to draw lines on a chart, and I didn't know why price was doing this thing, but I knew it was. But when you take the trade there, if you look left and you can't see any obvious reason, it's probably not going to be as likely to work. But equally, it could work because the odds are always 50-50. It's either going to continue or it's not. So you've always got a 50-50 shot when you press the button, which is why if you use a 1-to-1 risk-reward ratio, by pure blind luck, you're going to break even at some point. Yeah? Go and flip a coin 100 times. It ain't going to be much more than 49.51 because that's 50-50, isn't it? So you're just giving yourself the extra reason. So if this was sitting here at that level at 125 ADR and I saw a price action set up, an indecision, I draw a line and go, that looks pretty good. They've tested that area a couple of times. They tested it again there. Definitely bought that level. And they lost. So everybody that, if you believe in the theory, flips short there is probably going to want to stay short. They may not. When we get there, a news item might take it up to here. And these guys might get run over. But they will be part of the long move next. Yeah. Don't know. But, yeah, so that may well work. So you've got a pause happening, an inside bar potentially forming. If you then get a bearish move at that level on a lower time frame, if you jump down into M15, when you get a push, pause, pull, you will see a reversal alert. And this is why the reversal alert indicator exists. This is showing you the reversal happening on the low time frame that you are witnessing on the high time frame. This is showing you the reversal you are witnessing on the higher time frame. This is showing you the reversal you are witnessing on the higher time frame. Yeah, so the reversal alert is basically showing you on a higher time frame you've just had a signal to go long. That there yesterday, if you jump up a time frame, is that. Yeah, it's a bullish engulfing with a long wick. It's a reversal alert. Yeah, fractal. We're just going down with the reversal alert indicator. It's just telling you what's happening on a higher time frame. You're just seeing the actual order flow happening and unfolding that you would make a decision on a higher time frame, which is why I use multi-time frame analysis in the bootcamp. I'm trading H4 time frame. I'm trading extensions, continuous movement on the 4-hour time frame in one direction, but my entry is as soon as we get some action on a lower time frame that tells me that the bears are looking like they're starting to take control of the market. I'm getting in there. Yeah. And if that works, the 4-hour will have confirmed it with a candle that looks something like that. Or something like that. Or whatever. However big and strong the move is on the higher time frame. But we're looking to try and get in on the lower ones. Yeah. And if we're wrong, we look for what? The next level of potential support where we're expecting orders to be placed. So if that one's wrong and it pushes up, we go, no problem. Half an ADR up, we've got another area that we're likely to find orders triggering at. And we're still extended. We're now more extended. So let's move our price up a bit and hope that that is the one. And if that one doesn't work, we can get out. If it does work and you can hold it, you can clean up. If the market structure goes short, pay off your mortgage. Yeah. But we never know. You can never hold this because you just won't be able to sit there with something sitting in X $1,000 of profit and not shut the button, hit the button to shut the trade because you need the money. Your job is to make the money. And when the money's there, you take it. That's it. That's our job, isn't it? It's not getting it right. It's getting in at areas that help us or have a chance of helping us with an indication of our idea being correct and getting out when they give you a green number. That's it. That's your job. Nothing more complex. It's not to find the high. It's not to find the low. It's not to post that in Telegram and go, I'm the best thing since sliced bread. It's to get in, get out, take the money. And if it goes down to there, go, I made a profitable trade. I'll wait for the next area and I'll take another one. Yeah. Areas. That's what this is all about, identifying good trading levels. The targets for exiting price action trades and why they work is basically the inverse of what we've just covered. I'm not going to bother doing that session tomorrow because having now gone through this week so far and looking at that, it's like, well, it's obvious, isn't it? Yeah. If you are long on a trade and it hits one of these places that we would get in, you get out. Yeah, it's the inverse. So, Euro odd. So the reason I got out of this short, yeah, it doesn't matter why I took this short. There's a weekly level there, but got a short on. The reason I exited the short was because of this. And it's exactly the same as we've just been looking at, right? It's a propulsion gap. Price action at support. Yeah. So the inverse, if you are wanting to get into a trade, look for trades at price action, look for price action at support and resistance, market reversal alerts, etc. at the levels of support resistance. We're expecting limit orders to help us along our way. If you're in a trade and you get to one of those areas where you're expecting there to be help and you see the help, get out. Because if the help happens, that trade's going to become a loss. Yeah. So the session tomorrow, which I had planned, now I'm looking at it and I've written no notes underneath it, and now I know why, is because it's exactly what we've just covered in the inverse. Yeah. So if you're in a trade, regardless of what trade it is, Let's look at my US dollar CAD, which is screaming through the highs. So I'm about to get into a new short on it. If it ever gives a signal, which it will do in a minute, 3-bar reversal just gone in. So when we close below, there's no candle there because that is a doji indecision. When we close below this level, I'll be taking the next short. But when I get into all my trades, and you see me do this all the time in the live room, my targets are always at either a support resistance level that makes sense. Yeah, if we've got a weekly level, we've got a monthly level, we've got a daily level, we've got some kind of level, or it's at a propulsion gap. Because I know that those are the areas, because we've broken through them, if we return to them, there is a likelihood of a limit order trigger to drive it back the opposite direction. Yeah, so if I get in short now, and this was to, my average was to move up to, it's not going to get up in ADR, it's going to get up to somewhere around here, maybe even not that. Yeah, so my average is, let's say, going to come up to here. What I will be looking for is to price to come back down to here. Yeah, because that is a resistance, a propulsion move, and a support. So this area, they hit resistance, again, they broke through it, and they used it as support. So the sellers lost out and flipped long, helping the price along its way. So when it comes back down to this area, I would expect potentially the guys that bought here to buy again. So that becomes my target. Yeah, so it's exactly what we just covered. Look at a chart. If you think that's an area I'd like to get in and you're short, get out. Yeah. Now, it's obviously all discretionary. Levels are not discretionary. You could draw support and resistance discretionary. And again, I've done this experiment with other people before, but that move there is very big, very big. That is last month's high. That is going to have orders at it. That is the area I'm looking at because I'm wrong. So sometimes I'll get out and I'm wrong and I'll just take a tiny loss, a tiny profit, or a break even because this trade did not work. This could come all the way back down there, but I'm looking for areas it might hurt me further, which means I want to get out of it. Yeah, but you could use any of these propulsion gaps. Yeah, this is why we use them. Look, all these grey ones. These are all ones which are old. They've all been hit again. These are all green, blue. In the future, we will come back and look at this chart in X weeks, months time, and these will all be grey because price goes up and down. Just all it does. So, but this is obviously a parabolic move and uncharacteristic of the fundamentals at the moment. But anyway, but I've done this experiment in groups before, where you give somebody a chart and you get them to draw support and resistance on it. So if you were to open a blank chart and go to a daily time frame and say to someone, draw me all the horizontal support resistances on this chart, you would get back 10 different charts because everybody will draw it different. And that video that this is partly what I'm talking about now, is you would draw some in the same. Everybody would look at a chart and go, that. Yeah, and everybody would look at the chart and go, that. Obvious. 99% of people would go, that. Yeah, but all the intricate levels in between will be discretionary. Someone might put one there. Another person might put it there. Another person might ignore that accumulation and put it there. Then someone else will go, well, I prefer that support area there because it hit it twice. And then it kind of hit it again there. It wasn't exact, but I reckon that lot is because of that. So someone will have a line there. Someone will have a line there. If you draw a box from that low to that high, you create a zone. So when you get here, or here, or here, or here, or here, or here, anywhere in there, and you see some kind of price action, whether it be a reversal alert, whether it be a 3-bar reversal, a whacking great shooting star, followed by an indecision candle, followed by a whacking great shooting star, followed by a bearish engulfing, you take the trade. Does it matter if it's there or there? No, it's hereabouts. Yeah. So you can do this as an experiment. Go off and use a chart, any chart, it doesn't matter which you use. Just open a chart, go to the daily time frame, zoom out as far as you can go, right? And start drawing support and resistance on. Yeah. And then zoom in a bit and adjust your support and resistance. And then zoom in a bit more, and you'll find that instead of, so let's go out quickly here. So if you go to this level here, I'm going to draw a couple on that one there. Yeah. If you zoom in again, you'll find that that one is absolutely spot on. But, oh, that one looks good as well. And zoom out. And go, oh, yeah. So that high there. So I would have definitely picked that high and that double top. Ignoring that. Yeah. That's how you draw support and resistance. And then draw a box around it. Doesn't matter how big it is, but draw a box around it so that you know that it might go through it. It might not quite get to it, but somewhere in there it's going to react because it did react before. Yeah. This is the way I draw, and I was taught to draw support and resistance. The reason I created the indicator is because 9 times out of 10, the levels you draw on your chart will be weekly and monthly turning points. Yeah. So you'll find that is last month's low. You'll find that is the high of September. That is the high of August. Or May, one or the other. But monthly and weekly support and resistance points are turning points. And the reason they're turning points is because banks and institutions do not trade on 5-minute timeframes. They trade daily and weekly charts. So what they do is they say, if we get back to the last week's high, we'll sell it again because we sold it last week. If we get back to the high of 3 days ago where we sold it, we'll sell it again. We've had a bear month. So if it pushes up again into the previous month's low, we'll sell that month low because we sold it last month. They don't work on individual points in price. They work on general levels on daily, weekly, and monthly charts. So you don't need to draw anything else in, because they're not looking at them. If they're not looking at them, they're not going to help your trades operate. Yeah. That's it. That's all I've got to cover on that bit. 10:41. Another long session. I'm never going to be able to do these in an hour, ever, am I? It's just not going to happen. I wanted to also cover this strategy. I'm going to do this tomorrow. Because I'm sniffing. I'm going to do this tomorrow. We'll have a look at this Monday close strategy tomorrow, and maybe tomorrow we'll do some price action trading. Yeah. So Vitali's not in here, I don't think, are you? Or are you hiding away? But he's not, I don't think. Yeah, we'll maybe do some price action trading tomorrow, and we'll basically look through for some setups and take some trades, and we'll try this 1-to-1 thing and see if we can get some decent entries. Yeah. But just going through the thought process of what we're seeing on the chart, what's the candlestick telling us? Is this a decent level? Does it look like a good level we might be able to take a trade at or not? Yeah, and we'll take some trades and see how we get on. And obviously you can do this on any time frame as well. Yeah, price action trading doesn't have to be done on a 5-minute time frame. Do it on hourly. Yeah, if it comes down to this hourly level and you see a shooting hammer followed by after an indecision candle or whatever it is, whatever price action setup you see, take it. Yeah, and you just use a 1-to-1. You don't have to use a 1-to-1. You can use a, in this case, probably a 1-to-2. Come and retest that high if that low holds. Use whatever you want, but practice. That's what it's all about. It's about just building that muscle memory, which is why they teach you that in the banks. They tell you to just go and do the same thing over and over again until you come back with money. When you come back with money, we'll give you a job. Well, actually, they just give you a real account. Same as prop, isn't it? It's the same thing as prop. Prop give you demos accounts, and then they tell you they give you a real account. Same way as it works in banks. They don't sit you down and go, hi, welcome to your first day on the FX desk. Here's 100,000. Off you go. Yeah, you go through weeks and weeks and months usually of Can you do this? No. Well, here's your 3 months' wages. Piss off, because this guy can. That's the way it works. It's a ruthless job. There's a guy I know who's actually a kind of a relative sort of thing. Went for a job in a bank, right? An analyst job. And when he went for the job, he was one of 2,000 applicants. I think it was 5 or was it 10? Something like 5 or 10 new intern placements. 2,000 went for that job. If you're no good, there are a load of people behind you that will take your job. So they make sure you are good and you are going to make the money. You're not going to get it wrong. And the first thing they do is you sit you down and say, just hit the button. Understand why this moves and how it moves. And that's basically what it's all about this week, isn't it? Right, that's it. I'll leave it there. Anybody got any questions? I think we covered everything. Is anybody still there? Really wish I could see how many people are in the stream. It's really annoying. Oh, what was that? No. Pause. Doesn't give me any count at all of who's here. Jules is here. That's good. Danny's here. Look, nobody's liked it either. I'm going to like it. So yeah, I don't know. So I will be back tomorrow. FT next year. Forex Fire's here. Good. Jules is there. Everybody's here. Good. Well, 4 of you are here. 5. I'll be back tomorrow, same time in the morning. And then tomorrow we'll just make something up. Yeah, I think Friday we'll do a let's just talk about stuff. Let's do some price action trading. Let's have a look at that strategy. Harold's strategy as well. I have tested that quite a lot and I couldn't find any way to make it work on low time frames reliably. However, I think it might have an edge maybe on higher time frames. So might do some testing of that on higher time frames. And tomorrow we'll just basically do some stuff. And just generally look at things. And hopefully at 1:30 this afternoon, the US dollar has collapsed. Fingers crossed. All right, have a good day. If you need anything, I'll be in Discord. But yeah, we'll see you tomorrow. And if you've got any questions, obviously, chuck them in there. All right. Have a good day. See you tomorrow.